Hello everyone, welcome to KLI Market Commentary for the month of July 2022. I am Manoj Bharadwaj and I focus on managing fixed income investments in KLI. Today, I'd like to share our expectations on the likely outcome of the Monetary Policy Committee meeting scheduled between 3rd and 5th August 2022. But before I get to it, let me throw some light on the backdrop in which this MPC meeting is taking place. A few months back, just as the pandemic had begun to recede, the Russia-Ukraine conflict ensued and came as a rude shock as economies had to come to terms with a new reality, that inflation was no longer transitory. Supply disruptions had become more broad-based. Commodities across metals, energy and food started increasing at a fast clip. Inflation and inflationary expectations threatened to become unhinged. Labor shortages accentuated the inflation conundrum. The best laid plans of policymakers to ensure gradual withdrawal of accommodation was no longer an option. Central banks across the globe had to accelerate the pace of this withdrawal, and rightly so. India was no exception. Since April, the MPC raised rates by 90 basis points and promptly began the process of liquidity withdrawal, prioritizing inflation control over growth. In the recent weeks, the global landscape has undergone yet another shift. Recession fears have started to grip developed markets even as central banks continue to march forward with aggressive rate hikes. While inflation continues to print at multi-decade highs, the rate of change in inflation is expected to soften. Forward-looking surveys across developed markets point towards weak growth in the months ahead. Commodities have retraced by almost 30% from the recent highs. Recent developments on the domestic fronts has been broadly encouraging. CPI inflation for Q1 at 7.3% has been marginally lower than RBI's projections for Q1. Food prices in India have started showing signs of stability with a near normal monsoon, while spatial distribution of rains could still be a challenge. Government measures of duty cuts on food and fuel has also helped. We expect CPI for Q2 to undershoot RBI projections. We, however, expect RBI to stick with the CPI projections for the year until further clarity emerges. Add to this, the domestic growth has displayed good resilience even in this uncertain global environment. Credit offtake has also been encouraging. The external sector, however, is likely to remain under pressure as exports could slow due to slowing global growth and imports remain high due to robust domestic demand and elevated oil prices. We expect BOP deficit to top to $60 billion for the year and current account deficit at 3% of GDP. We expect rupee to trade with a depreciating bias. Given this context, we believe MPC will raise repo rate by 35 basis points to 5/4, taking the repo rate above the pre-pandemic level and continue with its policy of gradual withdrawal of liquidity. We expect them to continue with calibrated tightening until inflation shows signs of sustainably getting back under 6%. In this uncertain global environment, we expect MPC to assure markets of its readiness to shift gears if external sector vulnerability begins to start taking center stage or if inflation were to rear its ugly head again. Thank you.